Welcome to Chapter 6, Portfolio Risk and Diversification. In this chapter, we aim to understand how diversification works, calculate the co-movement of asset returns, and analyze portfolio performance in terms of risk and return. By the end, you'll know how to identify efficient portfolios and understand what makes some portfolios better than others. This is an introduction to the basics of portfolio investment theory. The overall objective is to provide some guidance on why some investments might be better than others and what happens when we combine assets into portfolios. In the second part, we'll explore how to create portfolios that reduce risk, recognize the minimum variance portfolio, and apply utility theory to choose the best portfolio based on personal preferences. This is critical for understanding how investors tailor investments to meet their unique goals. So an investment portfolio is a collection of assets like stocks, bonds, or real estate. The idea is to balance risk and return by diversifying. For example, a 60-40 portfolio, 60% stocks, 40% bonds, is a common mix for moderate risk investors. The combination balances the higher return potential of stocks with the stability of bonds. So each investor will ultimately create their own best portfolio that matches their risk and investment goals. Diversification reduces risk when the returns of assets don't move in perfect sync. For instance, if you own both Coca-Cola and Tesla, your risk is lower compared to owning just one. This is because their performance depends on different factors. Coca-Cola thrives on consumer spending, while Tesla is influenced by technology and energy trends. So diversification helps us to reduce risk. Depending on their co-movement, if returns are the same all the time, then owning those two stocks is the same as owning just one. So if stocks have different returns, and if stocks have different influences from outside the company, then diversification is ultimately going to be possible. This chart shows how combining stocks creates a portfolio with less volatility than either stock alone. Stock A is the red line, stock B is the blue line, and the portfolio in the middle is half of each. And it's not crystal clear, I guess, but I think what you can see is that the movement up and down across the board seems to be a little less with the portfolio than it is with either one of the individual stocks themselves. So again, if you were to invest equally in, say, Apple and Procter & Gamble, Apple's tech-heavy risk and Procter & Gamble's consumer staple stability complement each other. This helps to reduce portfolio risk. So what statistical measures do we need? The first is something called covariance. It's an absolute measure of co-movement that varies between plus and minus infinity. And of course, we have an Excel formula. If we know if we have the rates of returns, the first column would be asset A, and the second column would be the returns for asset B, and this would calculate the covariance. Again, covariance measures how two assets move together. A positive covariance means they tend to increase or decrease together, while negative covariance indicates opposite movements. For example, gold often moves in opposite direction of the stock market, making it a great diversifier. The challenge with covariance is it's difficult to understand the power of this. That is, what does the co-movement, how strong is that co-movement? So it's an absolute measure of of movement. Again, covariance is positive. That means it will have lower diversification opportunities. And again, the magnitude of this issue of covariance is very hard to interpret. Correlation is the statistic that we really want to talk about. Correlation measures co-movement, but it standardizes that so it ranges from a -1 to a +1. It essentially is the covariance divided by the product of the standard deviations. Now, the standard deviations, by nature, since they're a square root of variance, have to be positive. So the denominator here will always be positive. However, the covariance could be positive or negative. So correlation simplifies covariance by normalizing between -1 and +1. So correlation close to -1, like between stocks and treasury bonds, offers the best kinds of diversification potential. And again, using Excel, these calculations of correlation are, again, quite easy to calculate. So just to continue our discussion of correlation, it measures covariance, it measures a co-movement, right? If it's +1, it means they are exactly equal to each other. -1s mean they are exactly opposite of each other. So the best opportunities for diversification is when correlation is close to -1. However, as long as correlation is less than +1, we will see some benefit to diversification of combining those assets. So again, when correlation's +1, they move exactly together. For example, stocks in the same industry often have high correlation. By contrast, if you add international stocks to a portfolio, that introduces negative correlations and enhances potential diversification. A better example, imagine taking a $10,000 investment package and splitting it by investing $5,000 in PNC in Tesla, and you take the other $5,000 and you invest that at Fidelity in Tesla. These two accounts have a correlation of +1. What happens if something bad happens to the account at PNC? The exact same thing happens to the account at Fidelity. So +1, again, we can't really get a +1 correlation. So combining any two assets provides some level of diversification. The greater the number, the lower the number from +1, the closer we get to -1, the greater the diversification that we could have. So here's an example. This table shows the correlation of 10 stocks. Again, as you look across some of these stocks, I don't know what all of them are: JP Morgan, Apple, Bank of America, Home Depot, Disney, 3M, Walmart, IBM. I'm not sure what CVXNGS is. Goldman Sachs maybe is GS. But as we look at this, let's look at the correlations. See if I can make this just a wee little bit bigger for us. Make it a little bit bigger. So look at JP Morgan. And if you go down, let's find the one with the highest correlation. It's Goldman Sachs. So if you look at Goldman Sachs, the correlation is 0.831. It's a pretty high correlation. But we could actually, if we combine JP Morgan with Apple, it has a very low correlation. That would be a great investment to put together to get some diversification. As well as we have Home Depot 0.38, Walmart 0.212. So those would be great things to combine with JP Morgan. But now let's think about what about Apple and Home Depot 0.331. Again, a pretty low number. Apple and Walmart, again, pretty low numbers. So combining those stocks in portfolios would seem to give us greater potential for diversification. What about the relationship between different asset classes? So now let's look at the S&P 500. Compared to the S&P 500, if you look, there is actually the correlation between the S&P 500 and long-term treasury bonds is negative 0.38. So combining the stock market with the long-term treasury bond market creates great potential for diversification. And quite frankly, if you look at long-term diversification, it is negatively related, long-term treasury bonds, it is negatively related to all of the stock indexes. So again, we could kind of say, I guess, that bond types of investments are negatively correlated with stock investments. So when we combine them, we will ultimately get greater diversification than we would by combining other assets, such as what if we put the S&P 500, the biggest 500 companies, with the Russell 2000, which is the lower 2000 in size. So these are more smaller, mid-sized companies compared to large companies. It still has a pretty high correlation. Adding international investments to our domestic investment, again, combine it with the Shenzhen, right, component, that is a Chinese market, has a very low relationship to the S&P 500. So the idea here is when we're combining, creating portfolios, we want to start with asset classes. What do we want our asset class relationship to look like? We want it to be 60% stocks, 40% bonds. That gives us the risk relationship we're interested in. Now we have to figure out, as investors, what goes in that 60% stocks. We also want to diversify within that group to get the greatest amount of diversification for our investment needs. Look forward to talking to you in the next next presentation.